Welcome to What and Where to Invest 2022. The show must go on. Whilst uncertainties and disruptions may still linger in the world, at fsm1.com, we believe that investing is for the long term. It's not about timing the market, it's about time in the market that investors should pay attention to. We now turn our attention to the West and explore the West side story of growth. Europe and US equities has run up significantly in 2021 and valuations are at record highs. In this session, Chin from The Smart Investor is joined by Colin Low, an Assistant Manager, Macro Research at iFAST Singapore, and Cyrus Ng, Analyst, Macro Research at iFAST Singapore, to take a look at whether you should continue investing into these equity regions and discuss areas and sectors in light of the impending global recovery.
US and European equities saw solid performances in 2021, especially compared to their global counterparts. Today, we'll be taking a deeper dive into both equities with Colin from iFAST Macro Research Team and Chin from The Smart Investor. Thank you for joining us today. Starting off with US equities. They performed very well in 2021 with the S&P 500 recording gains of over 30%. Perhaps Chin could start. Could you explain to the audience what drove equities in 2021?
Sure. So good afternoon, everyone. I think that where I like to focus on is the S&P 500 because it's an index which consists of roughly around 500 companies. And these 500 companies make up, in terms of market cap, around 80% of the total market cap for the US stock market. So it's a significant and broad indicator of how stocks are performing. Now, when you look at the S&P 500 in 2021, it's the third year where they've actually recorded a double-digit return. And that's interesting, but for 2021, what is even more interesting is that all 11 industries which make up the S&P 500 have all recorded double-digit returns, which means that this is a very broad-based gain for the index itself. In fact, 8 out of 11 of those industries recorded 20% or more gains in terms of their individual industries, with the three biggest or best performers being energy, real estate, and IT. And of these three, I think IT deserves special mention because in terms of weightage, it makes up roughly 29% of the S&P 500. So it's a significant contributor for the S&P 500 compared to the energy and real estate, which only makes up 5.5% in terms of weightage. So if you want to boil it down to one major factor, I would say it's IT and big tech in particular.
Colin, do you agree that IT and big tech drove US equities in 2021?
Yeah, absolutely. I think what Chin said was right spot on. So if you look at the S&P 500, which returned about 29% for last year, and you can look at the index performance for S&P 500 IT index itself, they returned about 35% in their local currency terms. And of that, the composition or what drove the 29% of the total return for S&P 500, a good 9% comes from IT. So you can see that the strength and the size of IT and the importance it plays. And really a big factor that contributes to why and how IT drove such performance is the earnings power of the sector itself. So if we look at the past few quarters, we see very strong earnings beat coming from the tech sector. And a lot of companies have, both the magnitude as well as the number of companies beating earning estimates have been increasing over the past couple of quarters within that sector itself. So tech sector is definitely one key driver of the S&P 500. And the second driver of S&P 500, I would say, is the financials index itself. If you look at the financial index itself, it drove about 4% out of the 29% gains in S&P 500 in last year's year-to-date performance. And within financial itself, you see that it on aggregate, it holds about 11% of the S&P 500, but it contributes about 25% to its earnings on aggregate. And with such a huge driver of earnings being from financials, if you look at different banks and how the banks have performed over the past couple of quarters, we see stellar earnings results coming from these banks, and all these positive and earnings results have actually generated a lot of positive price reaction within the financials company, and therefore driving the S&P 500 as well. And aside from the sectoral perspective, if you look at from a style perspective, you also find that in the first half of the year, the S&P 500's performance is largely driven by the cyclical sectors such as your energy as well as your financials and your materials and industrial as well. And on the second half of the year, we see some rotation towards the growth sectors, those sectors such as your IT as well as your comms services and consumer discretionary, the big tech companies. And we see that style rotation are also answerable for how and why S&P 500 performed in a particular way over in 2021.
Thank you. Following on your comments on big tech, valuations for the S&P 500 have risen significantly, especially in that sector, and are currently at record highs. So our question is for Chin first. What are your thoughts regarding valuations, and do you think they present a risk or can they rise further?
Sure. So for me, valuation is a risk, but it may not be the biggest risk in terms, if you look at it from the point of view of an investor. For me, what is better to do when you're confronted with a scenario where you feel that valuations are high is to put aside the question of valuation first, put aside share prices, and look at the businesses which you want to own for the next decade. And I think that's really more important area to focus on, because business risk is not something you can manage easily. Valuation can be managed by portfolio management, but business risk is based on your choice of the company. And to me, that's a way more important piece of your investing process, which you need to focus on. By choosing a group of companies which you're comfortable to hold, you can then look at the valuation of those particular companies. You will have a list of companies to look at and be able to focus much better regardless of whether valuations are high or low. Now, I will make one comment about the NASDAQ, where it's down close to 8% from its high today, but 4 out of 10 of the NASDAQ stocks actually down by 50% or more. So if you're worried about valuation, there's a group of stocks which just got cheaper.
Thank you for your comments. Colin, do you agree on his views on valuations?
Yeah, absolutely. I think valuation itself, to some extent, presents a kind of risk. But the risk that I am looking at is the underlying catalyst that should or will be driving a possible valuation contraction. So where we are seeing valuation right now for the US, for S&P 500 in particular, with the current level of valuation, I think it lends certain risk to a valuation contraction or valuation or a drawdown. So what we think will drive this valuation contraction are two things. Firstly, a disappointment in earnings, and secondly, in the expectation of that the Federal Reserve will turn more hawkish than what market expects. So for the first factor is the one that we are actually more focused on, we are more vigilant on, and because if you look at earnings and how analysts are looking at earning estimates right now, we see a lot of optimism on their end and a lot of expectation that earnings will continue to remain high for the next couple of quarters. But really beneath the hood, we are looking at some faults are starting to occur. So for example, if you look at cost metrics for the S&P 500, look at some of these important cost metrics, you'll find that in fact material costs as well as wages have been rising, and with that as our base case, we do expect some form of profit compression, especially in the second half of the year. And then if that results in earnings disappointment, we might see some valuation contraction, therefore some drawdown in the US market.
Thank you, Colin, for your comments on valuations. Back to Chin. One thing you mentioned is that for companies, we need to look not just at valuations, but at the individual companies itself. The big tech forms a big part of the S&P 500 index. How do you think big tech will perform in 2022? And do you have any preferred picks in the sector?
Wow, okay. So full disclosure, I've owned all the shares in FANG before they were even called FANG. So my longest holding is actually Netflix from January 2016 2007. So that was 15 years ago. And I can tell you, having lived through this entire 15 years, I don't remember many moments where FANG was ever called cheap, right? So there's this interview from 2012 by Mark Andreessen, who's from the venture capitalist from Andreessen Horowitz. And this interview on Wired said two very interesting things, right? Number one, he said that there is no tech bubble. Now remember, this is 2012, right? And back in 2012, people were already talking about a tech bubble back then. And if you Google every single year after that, you'll find that the term tech bubble appears all the time. And I think everyone knows that if you had invested in FANG stocks any time in the last decade, you had done pretty well. If you missed out on that, you would have missed out on substantial gains. So why do people keep on calling it a tech bubble? I think that the one factor, and this is the second part of the interview, is that people has consistently underestimated the size of the market possible to grow. There has never been a time where there's a smartphone in the pockets of 5 billion people. There are 5 billion people connected to the internet before. This is a scale which has never existed before, and I think is severely underestimated till today. Now, today, of course, there's close to 5 billion people connected to the internet, but we just got here, right? I think the opportunities for internet scale businesses are substantial to build multiple trillion-dollar businesses in the future.
Thank you for your views, especially on internet companies. Moving back to Colin, do you see any key derating risks for investors to look out for in 2022?
Yeah, like I mentioned earlier, I think the number one derating risk that we are keeping an eye on is, of course, potential earnings disappointment. And that trigger for earnings disappointment will come in the form of higher costs for the US companies. And if you look at the recent data out there, the NABE, the National Association of Business Economics data, you will find that more and more companies, in fact, an increasing share of companies are reporting higher material costs as well as higher wages. And with the current level of that survey, it is also approaching is also approaching the historical peak level, which is seen from around third Q or fourth Q of 2018. And that is a time where we saw costs skyrocketing for many of these US companies. So soft data is already pointing to the fact that higher costs is a possible reality. And when we look at the index level data, look at the COGS level data, as well as the OPEX expenses of many of these companies, we are seeing that both metrics are in fact rising and in fact have bottomed out and turned higher over the past couple of months. So if you combine the soft data as well as index level data, we have quite conclusive evidence that, okay, cost is indeed rising. But is it time to actually worry now? We think no, because earnings are still coming in hot. And what's driving earnings is, if you look at it, the underlying economic fundamentals, the corporate fundamentals are still strong. So we do believe that profitability will continue to come in strong over the next couple of quarters. But the issue with cost as a headwind might come in the second part of the year, and we therefore see more room for profit compression in the second half of the year, and therefore that may trigger some level of earnings disappointment if consensus continue to maintain such optimistic level, and therefore could be a major derating risk that I have my eyes on.
Thank you both of you for your views. Let's move on to the pandemic. The US seems to be managing the Omicron situation decently compared to other parts of the world. Do you think the economic reopening will remain a key theme in 2022? Or should investors show greater concern about the Omicron COVID risk? Perhaps we could start with Chin.
Sure. So I think in the case of COVID itself, including Omicron, the one thing which we've learned, having lived with it for the last 2 years or so, is to expect the unexpected, right? Now, the good news here is, even though that doesn't sound like the most reassuring message, we are not without a playbook. We are not back in 2020 where we do not know what's going to happen. I think that if you are concerned about any impact to the business, look at 2020 data, right? That is when shutdowns happen. It will show you exactly how those businesses are impacted. You don't have to guess, you don't have to speculate. You have hard data of how a company will perform during a lockdown, right? And if your concern is whether or not they are able to recover from that lockdown, look at 2021 data, right? Last year's data, and see how these businesses are able to recover. Are they recovering stronger? And again, you have data. So in fact, I believe that the stock market has given you a gift where you have all this data available. You can make your own playbook about which company you want to own and which company can sustain or recover based on the data which you have. So you're not flying blind, even though there's uncertainty.
Thank you for your views. We are indeed not flying blind. Next, we'll move on to monetary policy. We'll start with Colin. Inflation is currently running pretty hot in the US, and the Fed is set to do about 2 to 3 rate hikes in 2022 itself. So Colin, do you have any thoughts on Fed's rate hike plans, and what does this mean for equities?
Right. I think that's a good question because this is definitely on most investors' mind after hearing what Fed's had to say over the meeting in earlier this week. So after looking through the minutes of the meeting, I think it can be said that there is a really high chance that we'll see rate hike and multiple times this year. So markets right now is in fact expecting rate hikes to come in around March and for at least 2 to 3 times for this year. So I do agree with that. I think we are very likely to see rate hikes this year and for about 2 to 3 hikes for this year. So if you look at the data underneath and supporting why there will be rate hikes, we look at primarily 2 things, inflation as well as the labor market. So when you look at inflation data, you'll find that components of inflation which are more sticky, which are like your wages as well as your rent. So these are the sticky components that result in more persistent inflation. Those data are indeed rising and in fact rising at a pretty rapid rate. So with that said, if you look at the labor market data, you'll find that, job is growing at about 200K per month, and that is really at a healthy level, despite the recent job number being a bit of a disappointment. But I would say at this stage of the economy, it is a very healthy number. And if you look at wages, which is the more important thing, which is what the Fed looks at when it comes to making interest rate decisions, you will find that wages itself has risen on an annual basis about 4.7%, and that has exceeded analyst estimates of 4.2%. And wages being such a big and important driver for inflation really comes into play and really tells the picture that the labor market itself is in fact very healthy and growing well, and there's not much of concern for the labor market. So all in all, if you look at the labor market as well as inflation data, it really supports the fact that there is a high chance that we'll have rate hikes coming in soon. And on top of that, if you look at the potential impact of a rate hike on equity markets, like the key thing to note here is that there is always a historical relationship where higher rate hikes will tend to put some pressure on equity valuation. So I'll give an example. So we look at S&P 500 over the past few decades, you'll find that whenever interest rates have been rising, we'll find that the valuations for US equities have in fact at best level and at worst have contracted. So we think this time around will be no difference. And if the rate hike comes in faster than expected, I think there would be potentially larger valuation contraction. But if it is well telegraphed and guidance from the Fed is clear, then I think valuation may face less resistance. But that is the sort of potential impact I see from monetary policy on the equity markets.
Chin, do you agree with his views on the rate hike, and what stocks do you think can benefit?
So I think in terms of rate hikes, the way I think about it is it has to happen at some point. So Colin already pointed out some of the preceding indicators that is probably will lead to rate hikes. For me, that there hasn't been many periods or many years, if you look back in the last 20 years, where you have rate hikes actually happening. We have enjoyed quite a long period of low interest rates. For me, when I look at stocks confronted by such a situation, I look at their earnings power, right? I'll look at whether or not they have debt, because interest rates will impact the companies which have debt on their balance sheet. But if they are able to sustain themselves without any debt, if they're able to fund and sustain and grow their business without needing more capital to grow, then I think those companies are the ones which you want to focus on.
Thank you, Chin and Colin, for your views on US equities. Moving on to European equities. Colin, how do you think they performed in 2021, and what do you think will their performance be in 2022?
Right. I think European equities have been quite a dark horse for many years until recently, where look at flow data, we see more hedge fund has been allocating into European equities, and it has started to pick up some steam. So if you look at what drove return for European equities, we must first understand the nature of European equities, which are in fact more of a value cyclical play as opposed to the US, which is more of a growthy market. So there are three attributes that supports the very strong cyclical performance. So firstly, it is if you look at, for example, Stoxx 600, which is the representation of European equities, you'll find that about 60% of the revenue is derived internationally. Then if you look at the composition for the Stoxx 600, you'll find that around 60% are the more cyclical sectors as opposed to the more growth/defensive sectors. And also, if you look at the monetary policy direction in Europe right now, it is relatively more dovish than the Fed, and also compared to many parts of the world. So these three factors, when taken all together, really points to the fact that if the global recovery should continue, and in our base case, we think it will continue for this year, it's likely to be very supportive for European equities given its cyclical tilt. And that itself has driven a lot of the performance last year. If you look at the very cyclical sectors such as your auto sectors, your industrial, your energy in Europe, those are the ones that have driven the first stage of the recovery. And when we look at the second stage of the recovery, which is more of a second half of this year, second half of last year, and the early parts of this year, we see that the consumer sectors are the ones that are driving that recovery. So the ones that are more cyclical, but at the same time less sensitive to the energy and industrial sectors. So we see a two-part cyclical recovery. And what do I think about European equities moving ahead? What I see two things that I really like as opposed to US equities. Firstly, valuations level compared to US equities are still relatively cheap. So I believe European equities are trading at a 26% discount to US equity based on a 4P ratio basis. And that is compared to a historical discount of 16%. So it is 9% discount more than what is trading at historically. And if you look at what has happened over the past 2 to 3 quarters, we'll find that European equities are getting cheaper and cheaper relative to the US, while prices are very comparable. So gains over the past 2 to 3 quarters are quite comparable, but valuations are getting cheaper. And in fact, when you take that and together with the discount trading at the US, we find that there is definitely relative value in Europe, and there is a scope for valuation expansion. And if you look at the earnings, corporate earnings for European equities, you'll find that European equities tend to have a 10-year CAGR pre-COVID of about 4%. And moving ahead over the next 2 to 3 years, we are looking at a growth rate of 7 to 8%, which is about double the historical level. And a big part of it is driven by the cyclicality, like I mentioned. And overall, taking both factors together, we have strong earnings growth, relatively stronger earnings growth, as well as room for valuation expansion. We do see very strong upside as compared to the US. So for Europe, for example, we are looking at a 13 to 14% upside over the next 2 years. For US, we are looking at about 6% because of its valuation and on average. So therefore, comparing both upside as well as the underlying drivers, we are leaning more towards European equities.
Thank you for your views on US equities. For one final question for Chin,
Sure.
On the US market, how do you think investors should allocate their investments and overall in the US market and beyond? And overall, do you have any final thoughts?
Sure. So I think in the US, what you actually get is a market which is pretty homogeneous. You have same language, fairly large market, just the GDP in the world, high consumer spending. And I think if you take it for that benefit, you are able to find a lot of businesses that can build a substantial or have a very long growth path just based on the local US market itself. So that is what the US market offers you, right? So I do see it as a core part of your portfolio. It is personally a core part of my portfolio. If you like to venture into emerging markets and so on, you may be facing currencies which are less stable, political systems which may be not as mature, and also situations which we don't see very often in Singapore, right? Recently, I found out that in Kazakhstan, there has been riots and the government just shut down the entire internet, right? So these are the kind of risks which we usually don't think of. But when you go into developed markets, such risks are typically less present.
Thank you very much to both Colin from our macro research team as well as Chin from the Smart Investor for joining us today on our discussion on US and European equities.